Hello everyone! Today we're diving into one of the more interesting and, let's be honest, often misunderstood parts of the Canadian tax system, the Alternative Minimum Tax, or AMT. The absolute best way to wrap your head around it is to picture it as a whole separate parallel tax universe that runs right alongside our regular one. It's got its own set of rules, its own deductions, and its own reasons for being.
So, let's pull back the curtain and see what it's all about.
Here's the game plan for today. We're going to start with the why of the AMT. Then we'll look at how its rules are different. After that, we'll walk through a case study to see it in action, pinpoint the common triggers, and finally, cover the most crucial part, how the AMT is more of a prepayment than a penalty.
Okay, first things first. Before we get into the nuts and bolts of how the AMT works, we really need to understand why it even exists. What's the point of this whole parallel system?
At its heart, the AMT is basically a safety net for the tax system. You can think of it as a fairness mechanism. It's there to make sure that high-income individuals who use a lot of deductions and credits, the system calls these tax preference items, can't wipe out their tax bill completely. It puts a limit on those tax-saving strategies to ensure everybody pays at least a certain minimum share.
So how does this actually work? Well, the logic is pretty straightforward. First, you do your taxes the normal way, then you do a completely separate calculation using all those special AMT rules. Step 3, you put the two numbers side by side. If the AMT number is higher, you pay your regular tax plus that extra amount. And if your regular tax is higher, which for most people it will be, then the AMT has zero effect. Simple as that.
Okay, so what exactly makes this AMT universe so different? Well, it all boils down to how it treats certain kinds of income and certain deductions. And those different rules can paint a very, very different picture of your taxable income.
This table gives us a great side-by-side comparison of the regular system versus the AMT. Now, we're not going to get lost in every single line here, but let's zoom in on some of the changes that have the biggest impact.
This, right here, is the big one. The absolute game changer. Under the regular rules, you know that only half of your capital gain is taxable. But in the AMT world, nope. The full 100% of that gain gets added to your income. You can imagine how this one change alone can cause the AMT income base to skyrocket.
Charitable donations also get a different treatment, and it's not as generous. In the regular system, your tax credit is based on the full amount you donated. Under AMT, they only base the credit on 80% of that donation. So right away, the value of that credit is reduced.
And the list just keeps going. As you can see, a whole bunch of common deductions and credits get hit. Things like the stock option deduction or the dividend tax credit, they're disallowed completely. Gone. Other things like employment expenses or childcare costs, they get cut in half. You can see the pattern, right? Each one of these adjustments is designed to increase that base income for the AMT calculation.
All right, theory is great, but let's be real. Seeing the numbers in action makes everything so much clearer. So let's walk through a case study together and see how these two parallel systems actually stack up for a real taxpayer.
So here's our person. They've got a solid business income, some dividend income, but, and this is the key, a really significant capital gain of $400,000. This is a perfect profile to look at because it includes exactly the kind of tax preference items we've been talking about.
Okay, here it is, the full side-by-side calculation. I know, it can look like a lot of numbers, but don't worry. Let's just break it down and focus on the key lines, comparing the normal tax calc on the left with the AMT calc in the middle.
The first thing that jumps out is right here, the taxable capital gain. Under normal rules, it's $200,000. That's 50% of the total gain. But for AMT, look at that. It's the full $400,000. That one adjustment just added an extra $200,000 to the income base for the AMT. Now, to balance out such a massive income jump, the AMT system has its own very generous basic exemption. For 2025, it's almost $178,000. This is really important. It's what helps ensure the AMT only kicks in for people with very high incomes who are also using these major tax preferences.
So after we run all the numbers, apply a flat tax rate of 20.5% for the AMT, and account for some credits, we land on our two final figures. The regular federal tax comes out to just over $62,000. The tax calculated under the AMT rules, $53,426.
And here's the bottom line. You just compare the two. Since the regular tax of $62,000 is higher than the AMT of $53,000, our taxpayer just pays the regular tax. That's it. The whole AMT calculation was done, but in this case, it didn't actually change their final tax bill. So this case study brings up a great question, right? If it didn't apply to someone with a huge capital gain like that, then when does the AMT actually get triggered? What are the common scenarios that make that AMT number climb higher than the regular one?
Well, it's usually a combination of high income and some of those major tax preference items. Having a very, very large capital gain is probably the most common trigger. But also claiming the lifetime capital gains deduction or having a big stock option deduction. Those are the classic situations that can tip the scales and make the AMT calculation take over.
And that brings us to our final section. And honestly, this might be the single most important thing to understand about the AMT. If you do end up having to pay it, it is absolutely critical to know that it's not necessarily a permanent extra tax.
This quote really says it all. You have to think of any AMT you pay not as a penalty, but as a prepayment of your future taxes. So, how does that work? How do you get that money back? The system gives you a 7-year window to carry forward any AMT you've paid. So let's say in year 1, you pay AMT. In any of the next 7 years, if you're in a situation where your regular tax is higher than your AMT calculation, you can use that AMT you paid in year 1 as a credit to reduce the tax you owe. You can just keep doing that until you've recovered all the AMT you paid or until the 7 years are up.
So, to wrap it all up, the AMT is a parallel tax system. Yes, it can lead to a higher tax bill in a specific year, but it's so important to remember that it's designed as a recoverable prepayment. Its goal is just to ensure a minimum level of taxes paid, especially by those benefiting from significant tax preferences. And this leaves us with a great final question to think about. Is the AMT an effective safety net for our tax system? A fair way to level the playing field? Or is it just an unnecessary layer of complexity that causes more headaches than it's worth? It's definitely something to consider. Thanks for joining me today.